Hello friends, welcome back. In my previous several covered call videos and also in the option wheel strategy video, many of you have asked questions and also expressed your thoughts on the strategies. I thought I will make this video to cover some of the important questions that you have asked, and also I will try to cover some of the variations of the covered call related to the questions that you have asked. So here are the questions that I have picked up. Return is less compared to the investment that you have made in the covered call. And when the stock or the index goes up, profit is fixed. It is better to buy a stock or an index and leave it for a longer period so that we can make more money. Which C strike to select for the covered call? What if stock or index falls? How to take a protection? What are the other variations of the covered calls? So let us look at it one by one. Before I touch upon these points, let me quickly recap about the covered call strategy. In the covered call strategy, you are going to buy an asset and then sell a call option against that asset. The strike that you are going to select is at the money or slightly out of the money based on the view of the stock. And the upside, the profit is fixed, and the downside, there is no protection unless we have hedged the position. So by nature, the covered call is not a investment strategy. It is a trading strategy wherein you keep generating the monthly rental when the stock is mildly bullish or bullish. In the case of ultra bullish, you will definitely feel that you are getting a fixed return. Friends, there is no strategy that is 100% foolproof and that gives you a maximum profit all the time. Covered call is one of the trading strategy. So therefore, we cannot compare this trading strategy with the investment. So if you are an investor, if you know how to pick a stock or an index and want to hold it for a longer period, the covered call is not a strategy for you. So regarding return is less compared to the investment, I have explained in my other videos. There are other variations of the covered call like poor man's covered call, using leaps. You can use those strategies if you don't want to deploy huge capital to do this strategy. So now let us address when the stock or the index goes up, profit is fixed. So let us assume that for a moment, you know that the stock is going to go up heavily. I still want to do the covered call and I own the asset, but I want to make a maximum profit in the case when the stock goes up heavily. So I will explain what can be done taking an example of one of the stock. Let me take the SBI and explain to you. So here I have taken State Bank of India, one of the stock. Let me create a covered call here. I am using the future. Assume that that is a asset that you have. Let's say I have bought the SBI one lot stocks at 788. So I have bought that and I want to initiate a covered call. So I already know that it is going to go up. Therefore, I am going to select slightly out of the money call option instead of at the money. This slightly out of the money, I choose 800 strike. So I sell 800 strike call option. So now if you see the payoff graph, the upside profit is fixed. Of course, downside is not protected. So this is a maximum profit that you get. That is 37,800 in this scenario. Let us now assume that you think the stock is going to go beyond 800. That is up to 810 or 820 or 850, we don't know. It is getting ultra bullish. You want to make a maximum profit in this scenario. So what you can do is you can buy a call option above the sold call option. Basically, you are going to create a credit vertical spread by buying a call option above the sold call option. So I want to buy, let's say 810, right? So now if you see the payoff graph, it is unlimited profit on the upside. So this is how you can make a maximum profit when the stock gets ultra bullish. And you can see here the payoff graph with lesser profit in this area. So all this you need to pay attention and go with your probable condition. End of the day, trading is a probability game. So you will have to take that call. Instead of credit spread, you can also make it as a debit spread as well. So it is up to you how you want to trade in the case of ultra bullish scenario. So this is how you can make a maximum out of the maximum profit when the asset or the stock is ultra bullish. Friends, for any trading, end of the day, you will have to predict whether the stock is going up or going down and take a bet on that. So for the third point, it is better to buy a stock if you are feeling that the profits are less and the stock is ultra bullish. You want to hold it for longer time. Don't even initiate the covered call. If you can predict, don't even initiate the covered call and keep the stock till it stabilizes to initiate the covered call. So that is an option. It is up to you. And as I mentioned, covered call is not a investment strategy. Now let us look at which C strike to select. So many of you have asked which C strike to select. So if you are doing a covered call continuously, you need to keep track of the break-even point. Let us say first time when you did the covered call, you collected, for example, 10 rupees. Second time when you did, you have collected 5 rupees. So basically, you have already collected 15 rupees from the stock. So your break-even point is reduced by 15 rupees for the third covered call. So based on your view, based on your break-even point, you have to select the call option strike. Let me go back to that SBI covered call to explain you. See, it all depends on what is your break point and how much the stock you are expecting it to go upside. If you are expecting let us assume that your break-even point is 780 and you are expecting the stock to go up to 800. You can select 800 strike directly. If you think stock is slightly bearish, what you can do is you can select 795 or directly 790 and collect the maximum premium. So this is how you have to think and take that judgment call based on the view. For any trading, end of the day, you need to have a view on the stock, and that view is also a probability game in the case of trading. So that is how you have to select the call option strike based on your break-even point number 1, and point number 2 based on how much bullish or bearish you are anticipating the stock. Next point is, what if the stock index falls? How to take the protection? Friends, there are two possible scenarios that I can explain. Let me take that SBI again. So I am selling 800 and buying this. So let us assume that my break-even point is at 788 and I sold the 800 call. So this is a max profit. That is what you have collected from the call option. Now let us assume that stock becomes bearish and you own the stock. So what you can do? When the stock becomes bearish, what will happen to this call option? I mean, the stock will start falling. The call option will start decaying. One of the things that you can do is close this call option. It might have decayed by 10%, 20%, whatever, and try to sell a future against the stock that you own. Let me explain you here. So I covered this call option. You might have collected some premium. Now, because I cannot select the asset here, I am going to sell a future against the asset that I own. The asset here, I am just taking this March month ka future long. I am treating it as an asset. Right? So what will happen here is this sold future completely protects your asset. So if you have sold the higher price than the asset price, the distance between that will be a profit irrespective of where the stock price goes. So you will have to deliver an asset where the stock or the future is going to expire. So that is how you can protect your asset against the huge fall in the stock. The other option is, if you are ready to pay the premium for the put option, you just buy a put option here. Suppose if your break-even point is 790 and if you have collected 13.55 here, you pay some premium to buy a put option. That's it. If it turns to be bearish, and before the expiry, you have an option to close this put option or shift the call option down. All these can be tried out. So that is how you can protect the asset from the falling market. The next point is, what are the other variations of the covered call? Definitely there are other variations of the covered call. You can watch the videos that I have already made. One of the variation is, if you have a less capital, you can use the leaps, that is buying the far expiry call option and selling the near expiry call option. So there is a detailed video on that. That is one of the option. It is also called as a poor man's covered call. And many of you have asked, why don't I use the future instead of the asset? I don't have to pay huge capital to buy a asset. Friends, in case of future, you need to know that when the future falls, of course you will collect the premium from the call option, but if the future or the stock falls heavily, the collected premium may not be sufficient to cover the loss of the future fall. So that is why you have to be careful while using the future. You need to protect the future by buying the put option, etc. And you have to see how much premium that you are collecting from doing that. The protection is one part, but also you will have to take care of the margin requirement that is required for the future, because the margin required for the futures are always MTM settled. So you need to maintain that margin. So as you know, the future is having an expiry date and it will be cash settled. You need to shed that much of cash in case if future goes in a loss. And when you are doing a credit or debit spread, pay attention to the amount of credit or debit that you are receiving or paying. As I mentioned, you always need to track the break-even point every time when you do the covered call. Another important thing to be noted is, there are taxes on the physical settlement. So when you settle the stock or the index, there will be STT, there is a long-term or short-term taxes. So pay attention to all of this. Friends, there is no holy grail in trading. Covered call is one of the trading strategy. It is not an investment strategy. I have explained you all the types of covered calls, their advantages, disadvantages. Do study them, practice them using a paper trading. See if it suits you or not. Then you can decide what suits you and pick the strategy that you may want to do. So end of the day, you have to decide what actually fits. You may also decide that the covered call may not be a suitable strategy at all. That's perfectly fine. So end of the day, you have to have a right view, and based on your risk appetite, you choose what you want to do, whether poor man's covered call with future, with protection or without protection, covered call with an asset, stock or an index. It all depends on individuals and their risk appetite. So end of the day, trading is all about individuals' risk appetite and the game of probability with the proper risk management. I hope you learned something out of this video. Thank you for watching. See you soon.